If you want to grow your money by 166%, this is one way you can do it. Well guys, no surprise, there will be many stocks mentioned in this video. So, fortunately or unfortunately, we do own some shares mentioned in the video. Of course, as usual also, this is not financial advice, right guys? Please speak to a pro if you need that sort of advice. Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it. Before we get on to the main topic of the video, we just want to say we want to thank Mr. SCG9065 for giving us the suggestion to look at some of the Kenanga Growth funds. There are quite a few of them.
Yeah, actually, there's a lot of them.
So we decided to pick one of them, right? SCG, if you feel like we didn't pick exactly the one you want us to pick, just let us know in the comments. And also, guys, if you have a fund that we have not reviewed before, just leave it in the comments and we will go to them, right? Now, let's begin on Kenanga Growth. Now, Kenanga Growth is, well, the first thing is we have 600 over, closing up to 700 Malaysian equity funds in Malaysia. Okay, obviously it's Malaysia. But Malaysia focused funds, right? And last time I remember, I did some math, right? Only 10 to 15 makes more than 10% a year before fees.
Correct.
And this Kenanga Growth one, I believe it might be one of them.
Maybe at the high. I'm not too sure. Okay. Maybe it's at the high teens.
Right. Yeah. So it's one of the best performing funds out there. That's why we decided to cover this. And it is in that top 1 or top 0.1% of funds in Malaysia that have managed to not just beat the market, but also beat the market very handily after fees. So this is the performance. Huge drop. For 2021, no surprise, because I suspect I know what they invested in, but they have been underperforming for a very long time. But you can see the outperformance happen. But this is another thing about investing, and that is, there tends to be periods where even if you do the right thing, you underperform, right? But you gotta be patient. So you can see here, it's a very patient fund since 2004. 18 years, and finally only recently they managed to outperform, and I take that back. I think based on the math I'm seeing here, they are not the highest return. They probably don't have double digits if I eyeball it, right? 160% in what, 18 years? Yeah, that's not the case.
Yeah, and just to also note that they are benchmarking with Bursa Malaysia Emas Index instead of a KL SCI. So this is their cumulatively fund performance. You can see that for each period, right? Since launch, they make about 166%. And then, but if you look at the latest period, which is like a 1 month period, right, they are actually down only a little bit, like 0.29% only. But if you look at this in the period wise in 2022, they actually underperform against the benchmark. So they're actually down like 23% versus 5% drop. Yeah. And this is actually one of the largest, or actually the largest fund that they invest in Malaysia's equity, Bursa Malaysia stocks. Yeah. And it's about 303 million. Yep. So that's just a quick fact. You can actually just check it out in their fund fact sheet. This is their asset allocation. So they are pretty invested in the company, in stocks, in equity. So you can see that about 70% it is in stocks, when they only hold like less than 30% is in cash. Not as safe or conservative as we did for iCapital. iCapital, they like 50-60%. So if you want to check out...
Not today, but on average.
Yes. So if you want to check out more about our review on iCapital portfolio, you can click the link over here. Yep. So this is Kenanga sector allocation.
No surprise. Yes.
Very surprisingly, it's quite concentrated. So you can see like they have like 29.9% is in tech stocks, And then in 27.6% is in industrial product and services, mostly are also serving the tech companies. And then we have 22% is in cash.
Yes.
So this actually just tells you that over 56% or 57% are actually invested in tech or tech related companies.
Yes.
Yeah. That's why I think that's why they put their Growth Opportunity Fund. Yeah.
That's right.
So just want to go a little bit deeper into the holdings. So this is the top 10 best performance in terms of the company that they have invested in. So if you look at the one on the bottom, you notice that, hey, they invested D&O quite a while back because they actually make about 553% gain.
Yeah.
Yeah, that's actually very impressive. But the not so impressive thing is that they didn't put a lot of money inside D&O. Yeah, that's the sad thing. Yeah.
I think so one insight I have about funds is that they tend to be not necessarily the best portfolio managers. So take, for example, this one, right? Like you found a company that went up 500%, but your fund is only up 166% over 18 years, right? And we know D&O only started to quote unquote wake up in 2020, 2021, right?
Yes.
So what does this tell you? Well, what it tells me at least is that they didn't bet hard enough.
Yeah.
And there are all sorts of reasons why they don't bet hard enough. There's each fund have their mandate, explicit or implicit, where they say I can invest this amount in a single company.
Yes.
And so as a result, it's a little bit wasted. Now the second insight is this: if you are a investor looking at all these funds, don't really look at the performance, because typically, like I said, right, out of 600 over funds, like 99.99% of them don't do well. But look at the companies that are typically, in the middle or bottom in terms of allocation. And I'll tell you why, right? We didn't quite do the comparisons here, but if we had to do it, let's say compared to 2019 or 18 and look at D&O's allocation, I'm quite sure, and we'll go to allocation later, I'm quite sure, right, it was in it wasn't a lot.
Yeah, it wasn't. It was actually very small.
Exactly, right? So what does this mean? It means that these fund managers actually are quite talented in picking out companies that are great. They just can't manage the portfolio as well as a retail investor can. So as a retail investor, you don't have to say, I need to invest in 30 over stocks. I can pick and choose. And when it comes to picking and choosing, look at the bottom half, I would say, of their portfolio, because those are the stocks most likely in the future to do well.
Yeah. But on the other hand, thankfully, they did put quite a bit of money in Great Tech.
Okay.
So that actually kind of cancelled it out. Okay, but they still got some stocks that they actually lost money. So later we're going to go into that detail. Yeah. They also hold quite a bit of Frontcan, I believe. Also.
Frontcan.
So these two companies, thankfully, they put a lot of money in it, except for D&O. Yeah, that's the sad thing. So this is the top 10 worst company. I think you actually see some of the well-known names at the moment. So you can see that, hey, what is this revenue group Berhad doing over here?
So here's the crazy bit, right? Like this is based on August
2022's But the buy price for revenue, it wasn't disclosed because
of course.
But then
you just assume August is the starting price.
And then basically, they actually did disclose the aggregate cost and also the number of units they hold. So I actually reverse engineer reverse engineer. So basically, they bought it quite at the top, which is around 1 ringgit and 10 cent or 20 cent, I cannot remember. But then thankfully, it is only 1.4% of their total NAV.
Yeah.
So that tells you a lot about position sizing. They didn't go all in revenue. Yeah.
Correct.
Just want to say that now. Yeah. So that is the top 10 worst performing stocks.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, I know this slide is going to be a little bit, you need to squint your eyes a little bit just
pause
to see.
And zoom if you want to see.
Yeah, just pause and zoom. But this is the entire portfolio that they are currently holding. You can see that I actually filtered it out from the largest amount of money that they put in until the lowest. Right. So if you look at D&O, it is at the bottom. The one that 500.
Oh my
The one
goodness.
500. Yeah. It is at the second bottom over here.
Did they sell?
No. At the moment, they haven't sold it yet. Yeah. So, and then this one, thankfully, there is, where is Greatech? I believe Greatech is around 8 million odd. But then in terms of market value wise, it is one of the largest now.
Yeah, I mean, you can see like Amylus.
Yeah, and it's down 6.
Yeah. And you can see they got in quite early with Dufu because Dufu is down as well, but they are in some 5-6% profit.
Yeah.
UWC, we all know UWC. It's so far a high performer. Dongguan. You got Franken, Hibiscus. These two are pretty decent performers.
Yep.
SKP Resources. This is one of Malaysia's greatest stock corporate stories ever. PIE, Scomnet. Well, Scomnet, I think if you measured this maybe a few weeks ago, they will be up, but not so.
Yep.
Kobe was a pretty big hit. They got quite high up.
Yes.
And don't know much about Hyaptek, Foundpack, before RGT.
Yeah.
Sam Engineering, are they making money? Yes, they are. Okay, that's good.
And then, I finally found Greatech is over here. So you see, they invested 4 million, 4.89, and then now their returns about 14 million. Unrealized gain.
So they are concentrated in tech, but they're not concentrated in specific sectors.
Yeah.
Specific companies.
Companies, yes, correct.
So, yeah, unfortunately for them, a lot of the companies here are companies that we own also.
Yes.
And I have to say it's pretty good.
Yep. Okay. So this is the current position size in terms of market value. So you can see that the biggest holding right now they're having is Greatech, which is 8%.
Yeah.
Actually, it's quite big for a fund, right? Normally they hold like 5% or less than that. So it's pretty surprising to see that they are not trimming their Greatech yet. So that's pretty interesting. And then the second and third one also is something related to tech sector. Franken 7%, UWC 6-7% also, right. And then Dufu also is the fifth place. Yeah.
So going back on my insight earlier on, right? If I was looking at this right now, if I want to use this as a reference point to find ideas, right? I'll be looking at, let's say, I don't know, Hyaptek and below. So companies like Uli, companies like Kellington, CCK, maybe not Revenue Group. Salutica, Optimax maybe. So it's very interesting because Vitrox and DNO compared to the guys up top there, minus Franken, they have a longer history of execution and stability and things like that. Yet, Greatech, UWC is up there. So that's a question mark for me. I'm not sure why there's such a difference. Maybe, valuation.
If you guys actually keep or store the Kenanga Growth Fund back in 2004, maybe you can share with us whether are they really holding D&O a lot, or was the amount always the same? Or
maybe they sold along the way. Who knows, right?
Because I believe the information, it is always updated one.
Yeah.
So the old information, you cannot get it. So you have to download it. Just to safekeep it.
Yeah.
Okay, so this is the final takeaway that we have. Although they hold about 43 stocks, but it's very concentrated. As you can see from the stock holdings, right? A lot of it is from tech-related sectors. And then the second point is that they bet the very big on Amylus. Is actually their number one most invested.
Right.
In terms of cost. Yeah, so they put like 11.8 million, and then they are losing 50% as of today's price. So hopefully that will pan out for them in the future. We shall see whether they will start to add more fund or not to average down. And then the last one is, not sure whether will they reduce their tech exposure.
Yeah.
But then the name of the fund is Growth Opportunities. So you never know. So maybe that fund is catered towards tech.
I think that is just the nature, right, of investing in not just tech, right? An area in tech, which is hardware, that is a lot more cyclical. And it's companies that, it's really a very, very up and down kind of business. It wouldn't make sense for them to reduce right now, personally. I think when all these companies, and some of the companies that are down big are, solid companies. And, when stocks go down, the behavior should be, should be to buy lah, right?
Yeah.
So if you're selling right now, you're behaving just like the typical investor, which you don't want to be that, right?
Right.
So you want to act a little bit in contrast. Now, saying this, the caveat is that you still need to have the right companies, right? It only applies if the companies are right. And you can't just say, well, the tech sector is going to come back up, so I'm just going to buy any random tech stocks,
right,
or semiconductor manufacturing stocks to do well. So these are some of the things that I would like to add. Now, I think when we say here that it is concentrated, important to note that it is concentrated in relation to other funds.
Yes.
Yes, but I would say it's not necessarily something that you as an individual investor need to follow. As you can see, some of the weaknesses, right, of investing the funds the way they've invested, it might protect your money, but maybe it won't help you grow faster. And after all, if you're looking at a growth opportunity fund, you want to quote unquote take more risks. Yeah.
Yes, correct. And also by taking more risks, they are also staying invested all of the time.
Yeah.
Like 77%. Yeah. So I would say it's a little bit tough for them to prepare for in case of market downturn.
Yeah.
With only 20% cash. So we shall see how are they going to manage this.
Now, speaking of 70% invested, there's another portfolio that is also like that, and that is the FIRL Pro portfolio.
Oh,
right.
Yes.
This is a smooth transition.
Yes.
Right? So this is a program. Yeah, this is a program that we started about 5 months ago. And right now, this is the performance as of January. I think the February numbers will look a lot better.
Yes, correct. So
part of it is luck, but part of it is also the talent and work of our research team.
Yeah.
And these are some of the performances.
Yeah. So I think in the February update, I believe there will be 2 companies that is actually over 100%.
Yes.
So finally. And we shall see whether we will have any unrealized losses or not for our portfolio. Hopefully, all of the stocks are in the green. Across, no promises. Yeah. And if you want the free sample of these FIRL Pro and also for our SIP program, you can check out the links. We put it in the description and comments for you to subscribe. It's totally free. You can just go there and check it out. And that's about it for today's video. Hope you guys enjoy watching today's reaction to Kenanga Growth Opportunity Fund. If you want us to react or review more of these fund management's portfolio, please let us know in the comments down below. And also, please give us a specific name so that it's easier for us to search and also to look. And with that said, see you in the next video.